Welcome back to the deep dive. We are glad you are here because today we are tackling a subject that I think 99% of people feel like they understand. But if you really press them on the mechanics, the actual plumbing of it, they would probably stare at you blankly. We are talking about ownership.
It is the fundamental building block of the entire financial system, really. But it's also, I think, one of the most misunderstood.
Exactly. I think for most of us, when we hear the word ownership or equity in a financial context, we have a very specific, almost cartoonish image in our heads.
Yeah, the ticker tape.
The ticker tape. We picture a stock ticker. We picture a line wiggling up and down on a screen. You buy the symbol, the line goes up, you get rich. The line goes down, you lose money. It feels very, I don't know, abstract.
That is the interface. That is the user experience of the market. But the back-end code, the legal reality of what you actually purchased when you clicked buy on that app, it is completely different. It isn't just a line on a graph. It is a bundle of rights. It is a contract. And most importantly, it is a very specific place in line.
A place in line. I like that. What do you mean by that?
I mean a literal queue, a hierarchy. When you buy a security, you are slotting yourself into a stack of other people, banks, suppliers, employees, the government, who all have their hands out waiting to be paid.
Okay.
And depending on what kind of security you bought, you might be at the front of that line, standing behind a velvet rope, or you might be standing way, way in the back, hoping there are some scraps left over.
I love that visual. So our mission today is to decode this menu of equity securities. We aren't just talking about stocks as one single thing.
As a monolith, yeah.
We have a stack of source material here, a really comprehensive overview of equity securities that breaks down this whole hierarchy. We are going to talk about common stock versus preferred stock. We are going to get into the really nuanced stuff like rights, warrants, and ADRs.
And what I love about the source material is that it forces us to look at the fine print. You know, we aren't just talking about price action.
No.
We are talking about voting power. We are talking about who has the legal authority to fire the board. We are talking about who gets paid first when the company goes bust. It's the architecture of ownership.
It is. So let's jump right in. Let's start with the big one, the one everyone owns or at least thinks they own, common stock.
The vanilla option.
The text literally calls it vanilla-flavored equity security. I love that. But I feel like that sells it short because vanilla implies boring. But when you look at the risk profile of common stock, it is anything but boring.
No.
It's actually the most aggressive asset in the stack, isn't it?
It absolutely is. Common stock is high octane. It is the engine of capitalism, really. The source material emphasizes that common stock is all about growth. And we need to define what that means legally. When you own common stock, you are what's called a residual owner.
Residual owner. That sounds leftovers-ish.
That is exactly what it is. It's the leftovers. But in a good company, the leftovers are where the fortune is. Think about the capital structure of a company like a waterfall.
Okay.
Money comes in at the top. Revenue. First, you have to pay your costs of goods sold, your operating expenses. Then you pay the bank interest on your loans.
Right, the debt holders.
Then you pay taxes to the government. Then you pay the preferred shareholders, which we will get to. Whatever is left at the very bottom of that waterfall, the residual, that belongs to the common stockholder.
And if the company invents the next iPhone or discovers cold fusion, that leftover pile becomes absolutely massive.
Exactly. That is the unlimited upside the text talks about. The bank that lent the company money. They only ever get their 5% interest. They don't participate in the boom. But you, as the common shareholder, you capture all of that value creation. There is no cap on how high your stock can go.
But, and there is always a but in finance, the source material has a very colorful, very direct way of describing the flip side of this equation. It says, if the business tanks, shares can become toilet paper.
It is a brutal image, but it is accurate. This is the price you pay for the unlimited upside. You have the ultimate downside. If that waterfall dries up before it reaches the bottom,
If you get nothing.
You get zero. Your shares are worthless. That is the deal you make.
I want to drill down on this liquidation priority mentioned in the source because I think this is where the place in line analogy really hits home for people. Let's say the worst happens. A company goes bankrupt. They are selling the office chairs, the patents, the real estate. They have a pile of cash from all that. Who gets it first?
Okay, visualize the line. At the very front, looking very serious, is the IRS. Taxes always come first. Always.
Okay, so Uncle Sam gets his cut. No surprise there. Who is next?
Next are the employees, specifically unpaid wages. If you work there and haven't been paid for 2 weeks, the court prioritizes you over the big banks.
That makes sense. That's fair.
Then you have the secured creditors. These are the banks that gave the company a mortgage on the factory or a loan against their equipment. They have collateral. They get to seize that collateral or get paid from the cash pile next.
Okay, so the secured lenders.
After them come the unsecured creditors. These are the bondholders who lent the company money without any specific collateral. It was just based on the company's good faith.
And the suppliers? The people who delivered the goods?
They're in there too as general creditors, the guys who delivered the paper clips and the coffee beans. They get in line. And the text jokes that even the landlord's cat is ahead of the common stockholder.
It's a joke, but it's barely an exaggeration.
It's really not. By the time the money filters down through the government, the workers, the big banks, the bondholders, and all the suppliers, usually the bucket is empty. As a common stockholder, you are dead last. You are the caboose. If the train crashes, the caboose gets crushed.
So this is the fundamental question then. Why would anyone on Earth accept being last in line?
Because of the control. This is the trade-off. You accept the ultimate financial risk in exchange for ultimate political power.
We're talking about voting rights.
Precisely. Bondholders don't get to vote. The bank doesn't get to vote. Preferred stockholders usually don't get to vote. But common stockholders, you own the place. You elect the board of directors. You approve of the mergers. You are the boss.
Now, this is where the source material gets into the weeds in a way I found really fascinating. It distinguishes between two types of voting, statutory and cumulative. I feel like most people assume one share equals one vote, and that's the end of it.
And that's statutory voting. That is the standard default setting for most large corporations. It's the simplest way to think about it.
How does that work in practice? Can we do an example?
Yeah, let's do the math. Suppose there are 3 seats open on the board of directors. Seat A, Seat B, and Seat C. And let's say you own 100 shares of the company.
Okay, I have my 100 shares.
Under statutory voting, you have 100 votes to cast for Seat A, you have 100 votes for Seat B, and you have 100 votes for Seat C. You cannot move them around. It's 100, 100, 100.
Okay, that seems straightforward and fair on the surface.
It seems fair until you look at the power dynamics. Suppose I am a whale investor, a big institution. I own 1,000 shares. And I want to put my 3 friends on the board.
Right.
I cast my 1,000 votes for my friend running for Seaway. You cast your 100 for your candidate. Who wins?
You win. 1,000 beats 100.
I win. I do the same for Seat B and Seat C. I cast 1,000 votes each time. I win all 3 seats.
So under statutory voting, if you own 51% of the shares, you control 100% of the seats on the board.
Exactly. It is a winner-take-all system. The minority shareholders are effectively voiceless. They can scream, they can complain, but the math ensures they lose every single vote.
So that's statutory. How does cumulative voting change the game? The text calls this a strategic nuance for the small investor.
Cumulative voting is a game changer for minority representation. It totally changes the math. Instead of having to vote seat by seat, the system says, okay, you have 100 shares and there are 3 seats open for election. So you have a total of 300 votes. 100 shares times 3 seats. You have 300 total votes. You can put them wherever you want.
Oh, I see. So I can pool them. I'm not stuck with 100, 100, 100.
You can stack them. You can take all 300 of your votes and dump them entirely onto one single candidate for Seat A. You can ignore Seat B and C entirely.
So if the whale is spreading his votes out, say, he puts his 1,000 on each of his 3 friends, and I can organize a few other small shareholders.
Exactly. Your 300 votes might not be enough, but if you get a few friends together, you might be able to stack enough votes on one specific candidate to beat the whale's spread out votes for that one seat.
So you're saying we could maybe get 1,001 votes on our guy for Seat A and let the whale win seats B and C.
Precisely. You won't control the board, but you can force one person onto it. You can get a seat at the table. You can get someone in that room asking the tough questions.
That is fascinating. So cumulative voting is essentially a mechanism for diversity of opinion on the board.
It is. It prevents the majority from turning the boardroom into an echo chamber. That is why you will often see activist investors fighting for cumulative voting to be adopted and entrenched management fighting against it. It is a battle for a voice.
Okay, so we have the vote. Now let's talk about the money, specifically dividends. I feel like there is this common assumption that if a company is profitable, I, as an owner, am entitled to a share of that profit.
The check is in the mail fallacy.
Right. But the source is incredibly clear on this. Dividends for common stock are never guaranteed.
Never. I don't care if the company made $100 billion last quarter. The board of directors has total discretion. They can sit down and say, you know what? We are nervous about the economy next year. We are keeping the cash.
Or they want to build a new factory.
We want to build a new factory in Ohio. We are keeping the cash. Or we want to do a big share buyback instead. They can do whatever they want with that profit.
And as a shareholder, I can't sue them. I can't say, hey, that's my money.
You have zero legal recourse. You are a residual owner. You get what they decide to give you. And even when they do decide to give it to you, the government is waiting with its hand out.
Ah, the tax angle. The source mentions qualified versus ordinary dividends. Can we unpack that? Because tax law is usually where people's eyes glaze over, but this actually impacts your bottom line significantly.
It does. Think of it as the government incentivizing a certain type of behavior. The government wants stable markets. They want long-term investors, not short-term gamblers. They don't want people flipping stocks every hour.
So they punish the flippers with taxes.
In a way, yes.
Mm-hmm.
If you buy a stock on a Monday and a week later it pays a dividend, that is considered ordinary income. It is taxed at your regular income tax rate, which could be 37% or higher depending on your bracket. It's treated just like your salary.
Okay, that's a big chunk. But if I hold it...
If you hold the stock for a specific period, usually more than 60 days around the time the dividend is paid, the government says, okay, you are a real investor. You have some skin in the game. They classify that dividend as qualified.
And the tax rate for qualified dividends?
It drops significantly, usually to 15% or 20% for most people, sometimes even 0% for lower income folks.
That is a huge difference, 22% difference in some cases. So the tax code is literally designed to encourage patience.
Exactly. It rewards the long-term owner over the short-term trader.
Okay, let's pivot. We have covered the high-risk, high-reward voting power world of common stock. Now let's look at what the source calls the calm older cousin.
Preferred stock.
I have to admit, until I read this deeper dive, I always assumed preferred just meant better. Like, it's the VIP version of common stock.
A very common misconception.
But it's actually a completely different animal. It's almost not even a stock, is it?
It is a legal chimera. It is a hybrid. Legally, on the balance sheet, it is classified as equity. You are an owner. But practically, economically, it acts almost exactly like a bond. It acts like debt.
Explain that. How does a stock, an ownership stake, act like a bond, which is a loan?
Well, think about why you buy a bond. You buy it for the steady interest payments, right? The coupon. You want income.
Right, predictable income.
Preferred stock is designed the same way. When you buy a preferred share, it usually comes with a fixed dividend rate stamped right on it. You might buy a 5% preferred share.
So it doesn't matter if the company's profits double next year.
Nope. You get your 5%. It doesn't matter if the company's profits get cut in half. You get your 5%. It is fixed income.
And this is where the preferred part comes in regarding our line, right? The dividend preference.
Correct. Remember our waterfall. We said the common stockholders are at the very bottom. The preferred stockholders are standing on a ledge right above them. The company must pay the preferred stockholders their full 5% dividend before they can give a single penny to the common stockholders.
So you get paid first. That's the preference.
That is the trade-off. You give up the voting rights, because usually preferred stock has no vote, and you give up that unlimited growth potential. In exchange, you get priority, you get safety, you get to cut in line.
Now, the source material breaks down preferred stock into 4 specific types or flavors. And I think this is where the real nuance lies. These aren't just jargon terms. They are clauses in the contract that determine if you get paid or not.
Absolutely. These are critical. Let's go through them. The first and most common is cumulative.
Cumulative. Sounds like something gathering mass or stacking up.
That is exactly what it does.
Okay.
We just said that companies can skip dividends if they are in trouble. Even with preferred stock, if the company is literally broke, they might pause payments to conserve cash.
Okay, so that preference doesn't mean they can't ever miss a payment.
Right. But if your stock is cumulative, those missed payments don't disappear. They go into what's called arrears. They stack up on the books as a debt the company owes you.
So it's an IOU.
It's a very powerful IOU. Because of that preference rule, the company is blocked. They cannot pay the common stockholders, the CEO, the founders, the public, a dime until they clear that entire backlog of payments to you.
So it acts like a dam. The common stockholders are completely dry until the cumulative preferred holders are flooded with cash to make them whole.
Exactly. It forces the company to prioritize you. Now, if you buy non-cumulative preferred stock and they miss a payment, it's gone forever. You just lose it.
Wow. So always check if it's cumulative. That's a huge difference.
Answer.
Good tip. Next flavor, convertible. This sounds like the best of both worlds.
It often is. This addresses the biggest weakness of preferred stock, the lack of growth. Remember, if the company becomes the next Google, normally the preferred holder just gets their 5% and watches everyone else get rich.
Right. You're on the sidelines with your safe income.
Convertible preferred stock gives you an option. It says, at any time, you can trade this preferred share for, say, 10 shares of common stock. The conversion ratio is set in the contract.
So if the common stock price rockets to the moon,
You push the button, you convert, you stop being a safe income investor and you become a growth investor. You capture that upside. Venture capitalists love this structure.
that makes sense.
They get the safety of preferred if the startup struggles and just sort of limps along, but they get the massive upside of common if the startup IPOs and becomes a huge success.
That makes total sense. Okay, third type, callable. The source calls this the company's escape hatch. This doesn't sound good for the investor.
No, this one is not for your benefit. This is for the company. Callable means the company has the right to buy the shares back from you at a set price, whether you want to sell them or not.
That feels unfair. Why would they force me to sell my stock?
Think about it like refinancing your mortgage. Let's say a company issued preferred stock 5 years ago, and they were a bit risky, so they had to promise a 9% dividend to get people to buy it.
Okay, 9% is a great payout. I'm happy holding that for the next 30 years.
You are thrilled. But now, 5 years later, interest rates in the economy have dropped. The company has become more stable. They could borrow money or issue new preferred shares today at 4%.
So they are overpaying me.
They are drastically overpaying you. It's a huge drag on their finances. So if the shares are callable, they will exercise that right. They give you your money back, maybe a small premium, and they cancel those 9% shares. Then they turn around and issue new ones at 4%.
So I lose my high-yielding investment right when interest rates are low everywhere else, leaving me with nowhere good to put the money.
Exactly. That is called call risk or reinvestment risk.
Got it. Okay, and the last flavor, participating. This sounds like a bonus.
It is the bonus round. Participating preferred stock is pretty rare, but it's great if you can find it. It pays you your fixed dividend, say 5%, but it also has a clause that says, if the company has a blowout year and pays a huge dividend to the common stockholders, we get a piece of that too.
So you get your floor, but the ceiling is open.
Exactly. You get your 5%, and then you get to participate in the excess profits alongside the common shareholders. It is a rare feature, usually reserved for very specific situations or maybe desperate companies trying to attract cash, but it is incredibly valuable if you can find it.
Before we move off preferred stock, there's a specific risk mentioned in the text that I think trips people up constantly. Interest rate sensitivity. We hinted at it with the callable stuff, but can we explain the mechanics?
Yeah.
Why does the price of preferred stock drop when interest rates rise?
This is crucial to understand, and it's something people miss all the time. Since preferred stock pays a fixed amount, let's say it's a $100 share that pays you $5 a year, it is priced based on how that $5 compares to the rest of the world.
Okay.
Imagine you buy that share for $100. It pays you $5. That's a 5% yield. You are happy because at the time, the bank is only paying 1% on a savings account.
Sure, 5% is much better.
But then the Federal Reserve raises interest rates to fight inflation. Suddenly, you can go to the bank and get a risk-free government bond paying 7%.
Well, why would I hold a risky stock paying 5% if I can get 7% risk-free from the government?
You wouldn't. Nobody would. So what happens? Investors sell the preferred stock. There are more sellers than buyers. The price drops. It drops from $100 down to maybe $70.
Why $70 specifically?
Because at a price of $70, that fixed $5 dividend now represents a yield of about 7%. The price has to fall until the yield matches the new market reality.
That is the seesaw. Rates go up, the price of the existing preferred stock comes down.
Exactly. So you can lose principal value on a safe investment purely because the Fed changed its policy, even if the company you invested in is doing great.
That is a massive aha moment for a lot of people, I think. Okay, let's shift gears entirely. We've talked about owning the company. Now I want to talk about the derivatives. The source material has a section on rights and warrants.
This is where we move from owning to opportunities to buy. These are contracts that give you the option to purchase stock later, but you don't own it yet.
But they seem very similar on the surface. They both let you buy stock at a set price. What is the actual difference between a right and a warrant?
The difference is who they are for and what problem they solve. Let's start with rights, which are also known as subscription rights. The text calls this a loyalty reward.
A loyalty reward.
Okay.
Rights are designed to solve the problem of dilution.
Dilution is a scary word for investors. It sounds like my investment is being watered down. Can we use an analogy? Sure. Imagine a pizza. A nice large pepperoni pizza. It is cut into 8 slices. You own 1 slice. That means you own 12.5% of the pizza.
I'm with you. 1/8 of the pizza.
Now, imagine the chef comes out and says, we need to sell more pizza to raise money for a new oven. So he takes that same pizza and he cuts it into 16 slices. You still have your 1 slice, but now your slice represents a much smaller percentage of the total pie.
My slice didn't get smaller, but my ownership stake did.
Yeah.
I went from 12.5% down to about 6%.
Your voting power is diluted. Your claim on earnings is diluted. Companies know shareholders hate this. So before they issue those new shares to the public, they offer rights to existing shareholders first.
First dibs.
Yes. They say, hey, before we offer these new shares to the public, you have the right to buy enough new shares to keep your 12.5% ownership intact. It's called a preemptive right.
And usually there's a sweetener. It's not at the full market price.
Yes, the subscription price is almost always at a discount. If the stock is trading at $50 on the open market, the right might let you buy it at $45.
That sounds like free money. The right itself has immediate value.
It does. But there is a catch. Time. The source emphasizes that rights are very short-term, usually 30 to 45 days. It is a use-it-or-lose-it offer.
What if I don't have the cash? What if I'm broke this month and can't afford to buy more stock, even at a discount? Do I just lose out?
This is the important part. Rights are tradable. They are securities themselves. You can sell the right on the stock exchange.
I can sell the coupon.
Exactly. You can go onto the market and sell your right to buy at $45 to someone else. They will pay you for it because they want the discount. So even if you don't subscribe and buy the shares, you can monetize the right and still get some value.
Okay, so rights are short-term, discounted, and meant to protect insiders from dilution. Now, what about warrants? The text calls them a sweetener and a lottery ticket.
Warrants are almost the opposite in their purpose and structure. Rights are for insiders. Warrants are usually for outsiders. Rights are short-term. Warrants are very long-term.
Give me a scenario where a warrant exists. Why would a company issue these?
Let's say a company wants to issue bonds. They want to borrow money. But maybe they are a little shaky. Maybe they are a tech startup with no profit yet. Investors are saying, I don't know, 4% interest isn't enough to compensate me for the risk of lending you money?
So the company needs to sweeten the pot to make the deal happen.
Right. So they attach a warrant to the bond. They say, okay, buy our bond, get your 4% interest, and as a bonus, we will give you this warrant. This warrant lets you buy our stock anytime in the next 5 years for $100.
But the stock is trading at $50 today.
Right. Today, the warrant is out of the money. It has no intrinsic value. Why would you pay $100 to buy something you can get for $50 on the market?
You wouldn't. It's
What?
worthless today.
But you have 5 years, or sometimes 10 years. You are betting that this startup is going to be the next Amazon. You are betting that in 5 years, the stock will be at $500.
I see. And if it goes to $500?
You exercise your warrant. You buy the stock at the locked-in price of $100. You can immediately turn around and sell it on the market for $500. You make a massive profit.
And it didn't cost you anything extra to get the warrant?
Usually not. It came attached to the bond as a sweetener. That is why it's a lottery ticket. If the stock stays at $50 for the next 5 years, the warrant expires worthless. You tear it up, but if it hits big.
So rights are for protection, warrants are for speculation.
Perfectly said. That's the core difference.
This is really clarifying. It stops being just finance soup and starts looking like a toolbox. Different tools for different jobs. Speaking of tools, let's talk about the tool for going global.
International investing.
Yeah.
Yes.
I love traveling. And I know a lot of investors want to own companies outside the U.S. We all use products from Samsung or drive Toyotas or eat Nestle chocolate. But buying stocks on the Tokyo Stock Exchange or in Switzerland sounds like a logistical nightmare.
It is. I mean, think about the friction involved. First, you have to convert your dollars to yen or Swiss francs, paying a fee. You have to open a brokerage account in a foreign country, which might require residency or have all sorts of legal hurdles.
And different tax laws.
You have to understand foreign tax laws, and you have to trade in the middle of the night because of time zones. It's just not worth it for the average person.
No.
Exactly. So the financial industry invented a brilliant workaround, the ADR.
American Depositary Receipt.
The source material explains the plumbing of this, and it is actually quite elegant. It relies on a custodian bank, a big U.S. bank.
A middleman.
A very important middleman. Let's say JP Morgan wants to help Americans buy shares of Sony. JP Morgan goes to Japan, they go onto the Tokyo Stock Exchange, and they buy a massive block of actual Sony shares.
Okay, so the bank physically owns the foreign shares.
They take those shares and they put them in a vault in Tokyo. They lock the door. Those shares are not moving. They are deposited.
Then what?
Then JP Morgan issues receipts against those shares back here in the United States. They're basically saying, I promise that this piece of paper, this ADR, represents one share of Sony sitting in my vault in Tokyo.
And those receipts, the ADRs, trade on the New York Stock Exchange.
Exactly. You, the investor, log into your E-Trade or Robinhood account. You type in the symbol for Sony. You buy it in U.S. dollars. You see the price in U.S. dollars. You get dividends paid in U.S. dollars. You trade it during New York hours.
That is incredibly convenient. It removes all the friction.
It does. It makes owning a Japanese company as easy as owning General Motors. But, and this is probably the biggest deep dive nuance of the entire episode.
I sense a trap. There's a catch.
It's not a trap, but it is a hidden risk that burns people constantly. Currency risk.
Explain this. Because I think most people assume, I bought it in dollars, I sell it in dollars, the dividends are in dollars, so I don't care about the yen.
That is a dangerous and very wrong assumption because the underlying asset, the thing in the vault in Tokyo, is priced in yen. The ADR is just a mirror reflecting that value back to you in dollars.
Can we walk through the math of a disaster scenario? I think it would make it clear.
Let's do it. Let's say you buy an ADR of a British company. The underlying stock in London is worth £100. And to make the math easy, the exchange rate is £1 equals $2.
Okay, so my ADR is worth $200. I spend $200 to buy it.
Right. You spend $200. Now imagine a year goes by. The company in London is boring. Their business is stable. The stock price stays exactly flat. It is still trading at £100 in London.
Okay, so the company did fine.
But something happens in the UK economy. A political crisis, a bad economic report, whatever. The value of the British pound collapses against the dollar. Now, £1 is only worth $1.
The currency got cut in half.
Yes. So the bank, JP Morgan, looks at that £100 share in the vault. They have to convert it to dollars to price your ADR. £100 times the new exchange rate of $1 per pound means your ADR is now trading at $100.
Wait, the stock price didn't move an inch? The company did nothing wrong? But my investment got cut in half.
You lost 50% of your money. And it had nothing to do with the company's performance. You lost it entirely on the exchange rate.
That is wild. So when you buy an ADR, you are actually making a double bet. You are betting the company will do well, and you are betting the foreign currency will stay strong against the dollar.
Precisely. You cannot separate them. If the U.S. dollar gets really strong, your international ADRs will suffer, just mathematically, even if the foreign companies are thriving.
That is a crucial takeaway. Is there any other friction we should know about with ADRs?
Just a quick note on taxes, foreign withholding.
Sounds ominous.
It can be annoying. When the foreign company pays a dividend, their local government, say the French government, might take a slice of it before it even leaves the country. They withhold taxes at the source.
So I get less money. And then does the U.S. tax me again on what's left?
Usually, no. The IRS has treaties to prevent this. They typically give you a foreign tax credit so you aren't double taxed. But it makes your tax return more complicated. And sometimes if the withholding rate is really high, you might not get all of it back as a credit. It's just a bit of a headache.
So ADRs are a convenient passport, but they come with currency baggage and tax paperwork.
Exactly. And one final distinction the source makes, which is important, sponsored versus unsponsored.
What's the difference?
Sponsored means the foreign company is involved. Sony goes to JP Morgan and says, please create an ADR for us. We want U.S. investors. They file forms with the SEC. They follow U.S. accounting rules. These are the ones that trade on the big exchanges like the NYSE or NASDAQ.
That sounds safe and transparent.
It is. Unsponsored is when the bank just does it on their own to make fees. The foreign company might not even know or care that it exists. These usually trade over-the-counter or OTC,
The pink sheets.
the Wild West. There is less regulation, less information, and less liquidity. It's much riskier. If you are looking for safety and reliability, you generally want to stick to sponsored ADRs.
We have covered a massive amount of ground today. I mean, we've gone from the liquidation line of common stock to the dividend dam of preferred. We've traded rights coupons, hoarded warrant lottery tickets, and crossed oceans with ADRs.
It really highlights that equity isn't a single thing. It's a spectrum of risk and reward.
Let's synthesize this. If you had to summarize the personality of each of these for our listeners to help them identify what they might want, how would you break it down?
Okay, let's try this. Common stock is for the optimist. You want control, you want unlimited growth, and you're willing to risk being last in line to get it. You believe in the upside.
I like that, the optimist. What about preferred?
Preferred stock is for the pragmatist. You want steady income. You want to be paid first. You are okay with a ceiling on your growth as long as the floor is solid. It's about safety and predictability.
Okay, that makes sense.
Rights are the insider's deal. A quick, short-term discount for the loyal shareholder who is already on board.
And warrants?
Warrants are the gambler's long shot. You have time on your side, but the odds are long. It's a speculative bet on a massive future success.
And finally, ADRs.
And ADRs are for the traveler. You want global exposure, you want to own pieces of companies around the world, but you have to watch the weather, the currency, and all the places you visit.
That is a perfect framework. It really helps categorize the risks and the reasons for owning each one.
And it brings us back to that first image we started with, the line.
The line behind the landlord's cat.
Right. When you are looking at your own investments or thinking about making new ones, I want you to visualize that line. When you buy a symbol on your phone screen, you are physically placing yourself in a queue.
So you have to ask yourself, are you comfortable standing in the back of the line for the chance of that unlimited upside with common stock? Or does your financial situation, your personality, require you to cut to the front with preferred stock, even if it means capping your potential gain?
There is no right answer for everyone, only the right answer for you, but you can't make that choice if you don't even know the line exists.
Knowledge is the only way to know your place in line.
Well said.
We encourage you to take a look at your portfolio this week. Dig into the details. Do you own voting rights? Do you have exposure to currency risk you didn't know about? Check the fine print.
It's always in the fine print.
Thanks for diving deep with us today. We'll see you in the next one.
See you then.